Welcome to the Real Estate 401k Show. Here are your hosts, Ryan Gerdes, Mike Weinstein, and Justin Frederick, helping you build a legacy of wealth through real estate. Powered by the Real Estate 401k Group at West USA and the Frederick team with Fairway Mortgage and MLS number 625918.
Welcome back to the Real Estate 401k Show, alongside Ryan Gerdes down at the end of the table, Justin Frederick in the middle, and I am Mike Weinstein. Appreciate you tuning in and listening to the podcast. It's always amazing when people outside of just our moms are listening. So we're so grateful. Justin Frederick is our resident mortgage expert. He is with Fairway Independent Mortgage, and when somebody wants to buy a home, whether it's for investment purposes, primary purposes, and you text into the show, we are going to introduce you to Justin and his team. And there's just a lot of, we're in the business. This is what we do. And I think there's so much information and so much knowledge that we have that we simply take for granted, and we assume that everybody else knows the same thing. And it's like that with any industry. Whatever industry you're in, you have a working knowledge that you assume everybody else knows. And Justin, there's still a lot of people a lot of myths out there about the home buying process as far as when it comes down to getting qualified for a mortgage, obtaining a mortgage. And I still, to this day, come across people who are under the assumption that you need a minimum of 20% down to buy a house. And I don't even know where that necessarily ever came from.
Yep.
But it's out there and it's prevalent. So let's explore some of these myths. Ryan and I, we read and write at the third grade level, so this is going to be perfect. So talk to us at our IQ levels.
I mean,
Ryan's more than just a pretty face.
So last weekend I was talking to a woman who was looking to buy a house as a primary residence, and they thought they needed 20% down. And first-time home buyers, so as a first-time home buyer with a conventional loan, you only need 3% down to purchase a home. So on a $400,000 house, you need $12,000 for a down payment. Now, you also have closing costs, and those can be covered by sellers depending on what the market looks like for that home. Leave it up to you guys to talk about that with them, but I can give them what they can expect for closing costs. Now, the beauty of 20% down is you get rid of mortgage insurance. But I think a lot of people think that they need to put down a minimum of 20% because they think that, hey, that's going to give me the best rate. In reality, it's actually the worst rate at 20% down, depending on what you're qualifying for. Because at let's just say 5% down, you have mortgage insurance. So mortgage insurance is giving the bank that comfort feeling of, hey, there's insurance on this. So it's the risk is not as high to them as if you put down 20% and that mortgage insurance is gone. So you can actually get a better interest rate if you put 5% down on a home rather than 20% down. So you probably guys didn't know that, right?
Well, no, they just did that.
They restructured.
Biden restructured that whole thing. And
yep.
What was that, about a year ago?
I think it was about 2 years ago
2
now.
years ago now?
Where they redid the loan level pricing adjusters.
Right, yeah.
So now, if you're trying to get rid of the mortgage insurance, there's things that you can do. It is required if you have less than 20% down. But let's say you have 20% down on a home. You could go 10% down. You could buy out of the mortgage insurance with a single premium on a conventional loan, and then keep some of that cash to maybe put in tile in a house or
let's go out and buy two homes.
There you go.
Save up a little bit more money. Let's put 5% down on home number A, and then save up a little bit more money with that remaining and go buy home number 2, and let's double down on our real estate portfolio. But that's just how I think.
I love those ideas.
Or a boat, a fishing boat.
Now, if you're putting down fishing boat, don't they say boats like just cost you a ton of money? It's just dumping money.
If it flies, floats. Well, never mind.
Now, if you're putting down 25%, then you're going to start seeing those better interest rates again. So that's your conventional products. Now, FHA, you could purchase a home 3.5% down. The problem with FHAs, and they're a great product. They're a great product for people with in the middle of credit scores, to fair to low credit scores, right? But you can do it with 3.5% down. The problem with them is they come with mortgage insurance for life on those 30-year loans. Also, they charge you for an upfront mortgage insurance premium of 1.75%. So it's pretty expensive. However, the beauty of an FHA loan is whether you have a 580 credit score or an 800 credit score, you're getting the same mortgage insurance premium. Whereas a conventional loan, those mortgage insurance premiums can really inflate once you start getting below the 700 credit scores. So FHA is a wonderful product for people with lower credit scores. Even in the 700s now, we're putting people into FHAs because the interest rates are traditionally lower.
Well, no, we've always mostly talked about different type of investment products and strategies and how to finance those. So now we're talking about, a lot of folks that are probably going to be using these as primaries.
Sure.
So that being said, the biggest audience of people that are getting primaries are first-time home buyers.
Typically.
Right? And so that being said, there's a lot of information and you had even brought it up earlier, that people are misled with when it comes to first-time home buying financing. So there's the ability to do 3% down, but most folks are under the impression that, man, I'm either going to get free money or I'm going to get a lot cheaper money because I'm a first-time home buyer. Can you talk a little bit about that?
Yeah, so there is some free money out there. There is grants out there. I wouldn't call it free, but
there's nothing free in life, pal.
Right. Typically, these grants come with much higher interest rates, and that's how they get their money back. But
and then they can't refinance or sell for a certain period of time. Generally speaking,
in most of those cases, you're looking at 3 to 5 years, either not being able to sell or refinance without paying that either a prorated portion back or all of it back.
And they call those prepayment penalties, correct?
No, not in that world, because the first mortgage is a quality mortgage, so there's no prepayment penalties on those. So it's only the grant money, and that wouldn't be a prepayment penalty. You're just required to pay it back if you don't meet their seasoning requirements. Okay. Now, there is some first-time homebuyer grant programs that are never forgiven, so it's important to know that too. If they granted you $15,000 and it's non-forgivable and you lived in the home for 30 years, you're still going to have a silent lien on there for.
So that's just a mini loan, pretty much.
Yeah.
And that's what that boils
interest
down
free.
to.
Yeah.
Now, if you refinance it, you just have to consolidate that silent loan with your primary mortgage.
I'll take an interest-only loan all day long, though.
Yeah.
All right. Well, this is Justin Frederick with the Frederick team at Fairway Independent Mortgage. Him and his team would love to have a conversation with you about the lending process, the qualifying process, and a lot more about the myths out there. If you'd like some more information, all you got to do is text the word loan to 623-AZ-RECON. That's loan to 623-AZ-RECON. I don't know what other myths you want to tackle, but one of the things that I find a lot with first-time home buyers is oftentimes I don't want to talk to a lender until I pay this off on my credit report, or I do this because my credit score is at this level and I got a medical bill that I need to take care of and so forth. And my response is always that's the worst idea, that you want to talk to somebody like you and your team, because oftentimes when we're trying to do the right thing, we are making mistakes that could jeopardize our chances of getting qualified for a loan.
Yeah, keep in mind, we are professionals. We look at this every day.
Ish.
And ish. So you could be wasting money, putting money into a medical collection that may not even be affecting your credit score. So we can take a look at that and see where everything's at and tell you exactly where to place money, or to keep the money as your assets. Maybe that helps you out more to have the money sitting in an account as reserves. for your purchase. So we hear that a lot too. We'll have initial conversations with first-time home buyers, and they're like, well, I have 3 credit cards and I owe $500 a piece on them. And I have a car loan that I want to pay off. Well, we may tell you, go ahead and do that, but we might look at your credit report and say, hey, you have a 760 credit score. You're above the top tier. Your debt to income ratio is low, so we don't even need to pay these off. Why don't you hold on to those monies for when you close? You're going to have moving expenses. Maybe you haven't even found a house yet. Maybe there's a house out there that you want to buy that requires a little TLC before you move in, and it can save you a bunch of money on the purchase for buying one.
True
of
or
those.
false, though? Sometimes the credit score that I'm seeing when I, as a consumer, go out and purchase and get a copy of my credit report, oftentimes isn't the credit score that you're seeing and that you're working from. And so sometimes consumers get caught up, oh, my credit score is this or my credit score is that. But when it actually comes down to qualifying for a mortgage, not necessarily the case.
It's very true. Most people.
See that, Ryan? I know what I'm talking about. Bro.
Hey, look, you showed some 4th grade status right there.
You're moving up.
Yeah, dude. Move to the head of the class. You're accelerated.
It's very true. A lot of these credit karmas, what you see on your credit card, automobile credit scores. So there's 10 different grading systems out there for credit, and we lend the most money, so we use a more traditional credit grading scale. And sometimes it's higher than what you see. Sometimes it's much lower than what you see. So I wouldn't put too much faith into the score that you're seeing out there. Now, if the score you're looking at shows you pretty close to perfect, you're probably pretty close to perfect when we're pulling your credit.
So what
too.
are the 3 bureaus that you guys pull? Because it's 3 bureaus, right?
Right.
So
TransUnion, Equifax, and Experian.
All right.
Same thing as everybody else, but there's just
Different
different
calculations.
grading through each one of those. We all use the same bureaus to
right,
pull.
but there's like Isaacs out there, and a lot of people get those confused.
Yeah.
So I think that's what we're trying to fish for is just because you go and you get your credit pulled at the car dealership doesn't mean that number translates over to Experian, TransUnion, and Equifax. I think is what we're trying to relay here.
100%.
All right. Any other myths out there? Anything simple that we want to talk about?
Let's see here. No, I really don't have anything else there.
All right. Well, this is
not off the top of my head.
well, good.
Yeah.
Way to make this an awkward closing. All right, this is the Real Estate 401k show. If you're interested in learning more about what your true credit score is and strategies to qualifying for a mortgage, Justin and his team are waiting to hear from you. All you got to do is text the word loan to 623-AZ-RECON. That's loan to 623-AZ-RECON.
Thank you for joining us on the Real Estate 401k show. If you want more information on how to build wealth, click on the link or text us at 623-297-3266. That's 623-AZ-RECON.